If you were born before 1958, there's something worth understanding about the number printed on your Social Security statement every month. That number was calculated by a massive government system processing decades of earnings records pulled from paper files, early computer systems, and records reported by thousands of different employers over a 35 to 50-year working career. The Social Security Administration's own oversight reports have documented for years that errors in individual earnings records and benefit calculations do occur, and they occur more often in records that span the era of paper record-keeping and early digital conversion, which describes almost everyone born before the late 1950s. This is not a conspiracy, and it's not true for everyone, but it is a documented, real pattern. And the only way to know whether it applies to you is to actually check. Today, I'm going to walk through exactly how your benefit is calculated, the 5 most common, well-documented error patterns that show up in older earnings records, and the exact steps to check your own record and request a correction if something is wrong. My name is Lucian Vane. I've spent years studying how Social Security benefits are calculated and the specific error patterns that show up in older earnings records, the kind of records that were originally created on paper, transferred between systems multiple times over decades, and compiled from data reported by potentially dozens of different employers across an entire career. I want to be precise and honest with you throughout this video. I'm not going to tell you that everyone born before 1958 is being underpaid. That would not be accurate. What I am going to do is show you exactly where errors are documented to occur most often, and give you the specific tools to check whether your own record is one of them. Let's start with how your benefit is actually calculated, because understanding this is the key to spotting an error. To understand how an error could exist in your benefit, you first need to understand the actual formula the Social Security Administration uses, because once you see how many individual data points go into it, it becomes clear exactly where a mistake could slip in. Your Social Security retirement benefit is based on your 35 highest earning years, adjusted for inflation, which the SSA calls indexing. Those 35 years are averaged into a figure called your average indexed monthly earnings, and a formula is applied to that number to determine your primary insurance amount, the foundational benefit figure that everything else is built from. Here is the critical detail. This calculation requires 35 complete, accurate years of earnings data. If you worked fewer than 35 years, the missing years are counted as 0, which lowers your average. And if any of your actual working years are missing, incomplete, or recorded incorrectly in the SSA's system, that also lowers your average, exactly as if you hadn't worked that year at all, even though you did. This is exactly why the era you worked in matters so much. If your working career began in the 1960s, 1970s, or 1980s, a meaningful portion of your earnings history was originally recorded on paper, processed through early mainframe systems, and later migrated into the digital systems the SSA uses today. Each one of those transitions was a point where a transcription error, a misfiled record, or a mismatched Social Security number could have occurred. The Social Security Administration's own Office of the Inspector General has published reports over the years documenting categories of earnings record discrepancies, including misreported wages, name and number mismatches, and processing errors that disproportionately affect older earnings records compared to more recently created ones. This is not me speculating. This is the SSA's own internal oversight acknowledging the pattern, which means checking your own record isn't paranoid. It's simply confirming that the data the formula used to calculate your check actually matches your real working history. The first and most common error pattern is straightforward to understand and, fortunately, straightforward to check. A year where you worked and earned income, but the SSA's record shows 0 or an incomplete amount. This typically happens for one of a few reasons. An employer failed to properly report your wages to the SSA in a given year, which does happen, particularly with smaller employers or businesses that have since closed. Your Social Security number was recorded incorrectly on a W-2 at some point in your career, which sent that year's earnings into someone else's record instead of yours, or into an unmatched holding file. Or a data transcription error occurred at some point during the decades your record has existed in the SSA's system. Here's a detail that matters specifically for people born before 1958. The SSA maintains a separate file for earnings that couldn't be matched to a specific individual's record due to a name or number mismatch. As of recent SSA reporting, this file called the Earnings Suspense File, has accumulated billions of dollars in wages over the decades that were reported to the SSA, but never successfully matched to an individual's permanent earnings record. This means there is a real possibility that earnings you legitimately had in a specific year simply never made it into your permanent file and instead sit, unmatched, in this separate system, doing nothing for your benefit calculation unless someone identifies the discrepancy and corrects it. Here is exactly how to check for this. Log into your account at ssa.gov and pull up your full earnings statement, which lists your reported earnings for every single year of your working life. Go through it year by year and compare it against your own memory and any records you still have. Old tax returns, W-2 forms, pay stubs, particularly for years early in your career when you may have worked for an employer that no longer exists. If you find a year with no income listed or an amount that looks clearly too low compared to what you remember earning, that's a specific, checkable discrepancy. And it's exactly the kind of issue that gets corrected through the process I'll walk through later in this video. The second error pattern is closely related to the first, but specific enough to deserve its own explanation, because it affects a particular group disproportionately. People who change their name at some point during their career, most commonly through marriage. If you changed your name, most commonly due to marriage, but also divorce, remarriage, or a legal name change for any other reason, and that name change wasn't properly and promptly updated with the Social Security Administration at the time, earnings reported by employers after the name change may have been recorded under a name that didn't match the SSA's records for your Social Security number. This was a particularly common issue for women who worked through multiple marriages or name changes across a long career, meaning that one segment of their working life might be properly recorded under one name, while another segment, reported under a different name before the SSA's records caught up, ended up mismatched or unmatched. If this describes your work history, the years affected by a name mismatch are at real risk of being among the missing or incomplete years we just discussed in the first error pattern, except the underlying cause here is specifically traceable to identification records rather than employer reporting failures. Action step. If you changed your name during your career, pay particular attention to the years immediately surrounding that change when reviewing your earnings statement. If you have any old documentation, a marriage certificate showing the date of the name change, or old pay stubs or tax returns under either name, keep those readily available, because they become important supporting documents if you need to request a correction for that specific period. The third documented error pattern affects a specific group. People who were self-employed, ran a small business, or did freelance or contract work at any point during their career. Self-employment income is reported to Social Security differently than W-2 wages from an employer. It requires the individual to correctly file a Schedule SE as part of their personal tax return, calculating and reporting self-employment tax. And unlike W-2 income, where an employer automatically reports your wages directly to the SSA, self-employment income relies entirely on the individual's own tax filing being accurate and properly processed. This creates more opportunities for an error than standard W-2 reporting. A tax preparer who made a mistake on a Schedule SE decades ago, a self-employment tax payment that was processed incorrectly, or simply a year where the self-employment tax wasn't filed at all due to an oversight, can all result in that year's income never properly reaching your Social Security earnings record, even if you paid income tax on it. This is particularly relevant for people born before 1958 because self-employment tax reporting requirements and processes have changed and been clarified multiple times over the decades, and older filings are more likely to have been affected by since-corrected ambiguities or processing issues in the system. Action step. If you were ever self-employed, ran a small business, or did significant freelance or contract work, review your earnings statement specifically for those years with extra care. If you have old tax returns showing self-employment income that doesn't appear to match what's reflected in your SSA earnings record for that year, This is a specific documentable discrepancy worth pursuing through a correction request. The fourth error pattern is more complex, but it affects a meaningful number of people in this age group directly, and it can result in a benefit that's significantly lower than it should be. Incorrect application of the windfall elimination provision and the government pension offset. I covered WEP and GPO in detail in a previous video, but here's the relevant context for this specific topic. These provisions apply to people who receive a pension from work that wasn't covered by Social Security, common among certain teachers, government employees, police officers, and firefighters in specific states, and they reduce the Social Security benefit those individuals receive based on a specific formula. Here's why this connects directly to the calculation errors we're discussing. The WEP reduction formula depends specifically on the number of years you had substantial earnings under Social Security covered employment, and if your earnings record contains any of the missing or misreported years we discussed earlier, the system may calculate that you have fewer qualifying years than you actually do, applying a larger WEP reduction than the law actually requires for your real, complete work history. This means for someone affected by both a missing earnings year and the WEP, the error compounds. The missing year both lowers the baseline calculation and triggers a steeper reduction on top of it, which is why this specific combination is worth checking carefully if it applies to you. If this applies to you, the corrective action follows the same path as the earlier error patterns, correcting any missing or misreported years on your earnings record, but it's worth specifically asking the SSA representative to recalculate your WEP reduction based on your corrected complete earnings history, since this doesn't always happen automatically just because a year was added back. Action step. If you receive a pension from non-Social Security covered work and you've identified any missing or incorrect years on your earnings statement, when you contact the SSA to correct those years, specifically ask, "Once this correction is made, can you also recalculate my WEP reduction based on my updated complete substantial earnings count?" The fifth and final error pattern applies to a specific group, people who continued working, even part-time, after they began collecting Social Security benefits. Here's the relevant rule. If you continue working after you start receiving Social Security, and a year of that later work turns out to be one of your 35 highest earning years, the SSA is required to automatically recalculate your benefit upward to reflect that higher earning year replacing a lower one from earlier in your record. This recalculation is described as automatic, but it depends entirely on the SSA's system correctly identifying that the new year qualifies as one of your top 35 DAR, which means it's subject to exactly the same kind of data and processing issues we've discussed throughout this video. If that later year's earnings weren't recorded accurately, or if the comparison against your historical top 35 years wasn't processed correctly, the recalculation may not have happened, or may not have happened completely. This is particularly relevant for people born before 1958, many of whom continued working well into their 60s and even 70s, sometimes in part-time or consulting roles after a primary career ended, exactly the kind of later career earnings that should trigger this recalculation, and exactly the kind of situation worth specifically verifying rather than assuming happened correctly. Action step. If you continued working after you began receiving Social Security, compare your benefit amount from before that work period to your current amount. If it hasn't increased at all, despite a meaningful year or years of additional earnings, ask the SSA directly to review whether your record was properly recalculated to reflect that later work. Now let's walk through exactly how to check your own record, step by step, because everything we've discussed only matters if you actually go through this process. Step 1. Go to ssa.gov and either create or log into your My Social Security account. This is free, takes about 10 minutes to set up if you haven't done it before, and gives you direct access to your complete earnings history. Step 2. Once logged in, navigate to your earnings record, which will show you a year-by-year list of your reported earnings going back to when you first started working. Print this out, or save it as a document, because you'll want to review it carefully rather than scrolling through it quickly on a screen. Step 3. Go through it methodically, year by year, and flag anything that looks wrong. A year showing 0 when you know you worked, an amount that seems clearly too low, or any year during a documented name change, self-employment period, or late career work period that warrants extra scrutiny based on what we've covered today. Step 4. Gather any supporting documentation you still have for the years you flagged. Old W-2s, tax returns, pay stubs, or even an old employee badge or offer letter that confirms you worked somewhere during a specific period. You may not have everything for every year, and that's fine. Even partial documentation helps. Step 5. If you genuinely cannot locate old tax documents, you can request a wage and income transcript directly from the IRS, which shows historical income reported under your Social Security number and can serve as independent verification for a specific year you're questioning. Once you've identified a specific discrepancy and gathered what documentation you have, here's exactly how to request a correction. The form you need is called the Request for Correction of Earnings Record, Form SSA-7008. This form is available directly on ssa.gov, and it asks you to specify the year in question, the amount you believe is correct, and to attach whatever supporting documentation you have. If you don't have documentation for the specific year, don't let that stop you from filing the form. The SSA can sometimes locate records on their end, particularly through the earnings suspense file we discussed earlier, or by cross-referencing with employer records that may still exist, even if your own personal copies were lost or discarded decades ago. You can submit this form by mail or in person at a local Social Security office. While there's no strict universal deadline for correcting an earnings record, unlike some other Social Security processes, the SSA generally recommends correcting errors as soon as you become aware of them, both because documentation becomes harder to locate over time and because correcting the record sooner means your benefit reflects the accurate amount sooner. If your initial request is denied or you disagree with the SSA's determination, you have the right to request a formal reconsideration, and beyond that, a hearing. This is a structured appeals process, not a dead end, so don't assume an initial no is the final word. If your correction is approved, here's what happens next, and what you can realistically expect. Your earnings record is permanently updated to reflect the correct amount for that year. If that corrected year is now among your top 35 highest earning years, your benefit calculation is updated accordingly, which can result in an increased monthly benefit going forward. It's important to set accurate expectations here. Not every correction results in a higher benefit. If the corrected year's earnings still aren't high enough to displace one of your existing top 35 years, your monthly benefit amount may not change even though your earnings record itself is now more accurate. This is still worth doing for the sake of having a correct, complete record, but I don't want to promise a guaranteed increase for every correction. In cases where a correction does result in a higher benefit calculation, the SSA can generally also issue a retroactive payment to cover the difference between what you were paid and what you should have been paid, going back to when you started receiving the incorrect amount, though the specific rules and limits on retroactive payments can vary. So ask the SSA representative directly about your specific situation. Here is your complete action checklist. 1. Create your account at ssa.gov and print your full year-by-year earnings record. 2. Review it methodically, flagging any year showing 0 earnings you know you had, or an amount that looks clearly too low. 3. Dossers pay particular attention to years surrounding a name change, any self-employment period, and any work you did after you started collecting benefits. 4. Gather whatever supporting documentation you still have, and if you can't find your own records, request a wage and income transcript from the IRS. 5. File Form SSA-7008 for any specific year you've identified as incorrect, with whatever documentation you have attached. 6. If you receive a non-Social Security covered pension and a correction is made, specifically ask the SSA to recalculate your WEP reduction based on the updated record. This entire process exists because the system that calculates your benefit is enormous, decades old, and built from millions of individual data points. And like any system of that scale and age, errors happen. Checking your own record isn't about assuming the worst. It's about confirming that the number on your check actually reflects the real career you had. If this video helped you, subscribe. Every week I cover the Social Security rules, processes, and corrections that most people only learn about after years of an issue sitting unaddressed. Share this with anyone you know born before 1958 who has never actually reviewed their full earnings record. A single afternoon spent checking could mean the difference between an accurate benefit and one that's quietly been wrong for years. I'll see you in the next one.